Hello, friends. Welcome to this special episode. So, best PSU bank funds to invest today is the topic of the day. Uh, Regular viewers know this will be a fun clickbait. For the rest, I assure you, this will be worth your time. So, now what have we been hearing recently is that there are a lot of PSU funds getting launched. So, NFO by several AMCs. Uh, Launched in the last couple of months. Everybody wants to get onto the bandwagon. Uh, all the analysis in many of the papers is about banking and PSU stocks. More funds, whether they are fundamentally oriented or quantitative based. Um, Launching of quant PSU funds here. This last 1 year has seen so many PSU funds. uh, HDFC Bank, HDFC Mutual Fund launches Nifty PSU Bank ETF. Uh, so there has been a sort of a euphoria of sorts, literally in everywhere today. So what this is causing is a lot more liquidity is entering that same sector because a lot of selling is happening in that particular sector. So for instance, as of 31st March 2024, 160 schemes of sectoral and thematic funds, not just PSUs, but even otherwise, uh, have have been launched, and 36% of the entire market is has been shifting towards sectoral funds. What are the some of the facts behind sectoral funds performance basis wise? You can see that, for instance, let's take PSU banks. Now, PSU banks versus Nifty has been a love and hate relationship all this last, 15, 17 years. And when we plot PSU banks versus Nifty 500, we find that every other year, PSU banks outperform, every other year they underperform in a big way, outperformance, underperformance, and then few years of, continuous underperformance, then couple of years of outperformance, and then so on and so forth. So this is what has been happening all this while. Now, to understand this, let's go into two specific phases. Uh, Here you can see that this is PSU banks versus Nifty, where phase one was pre-COVID. So you had 4 years of almost negative negative performance or underperformance in a big way. So you had 12%, 14%, 26%, 48% versus CNX 500, and you had 2 years of outperformance in a big way, and then 2 years of mild outperformance on the upside. This has been the data so far. So in this period, you can see that while Nifty 500 or CNX 500, if you may call it, was going up nearly 47%. CNX PSU banks in the same time period lost 25%. So post 2018, the CNX 500 remained stable and went up, whereas PSU banks were rallying down. So nobody was selling PSU banks new fund offerings or ETFs at that point of time. Why not? I mean, if all these funds were so value oriented or were so oriented towards finding the best points of picking these stocks, they should have ideally bought here, right, after a good kind of a drop for a couple of years. But nobody was doing that, right? And the fact is that, if you look at private banks in the same time period, private banks were doing exceptionally well. So Nifty private banking was up 79.6% in the same time period, whereas PSU banks were, collapsing minus. There's a huge gap. I mean, just in a matter of 4 years, something goes from 100 to 179, and a competing entity goes from 100 to 75. That's a huge, huge gap, very difficult to cover. Now, going to phase two, where some euphoria was there in the market, but PSU banks started to run very, very hard versus CNX 500. And here you can see the CNX PSU bank index post the COVID bottom really took off versus CNX 500. So CNX 500 from bottom of 2020 till now is 200%. CNX PSU banks is of 556%. So that's a huge recovery from where they were. If you just see this period, then this is a huge outlier versus the Nifty private banking, which has not even been able to match the CNX 500 returns on this. So when you combine these two phases, you find that while PSU banking index really crashed relatively to the CNX 500 and the private CNX Nifty private banking private banks, you had a huge recovery in PSU banking index to almost come back and match and actually beat Nifty private bank over the past 8 years or so. But both did not beat CNX 500. That has been the journey of these two indices. Now, if we go further back, since 2007, CNX 500 has done 12.4%, whereas PSU Bank's index, because they were very choppy for the entire decade, and only this last phase has seen a huge flurry of recovery here, are up only 289% versus the benchmark uh, broader market at 574%. So nearly only 50% of performance has come over such a long period of time of nearly 17 years. So the truth is that the PSU index, or especially the PSU banking index, has not been able to outperform the CNX 500 over the long term. And only when this index is rallying in the last couple of years do all these AMCs, ETFs really try to sell this index. That and this was the case in 2011-12 also. When this rally happened here, a lot of selling of PSUs happened, and those investors really had to wait for 12-13 years to even come back to capital. Now, I'm not saying that PSU banks are going to fall tomorrow and this is the top. Maybe it will go higher, but there is a good chance that this flavor will change in coming times. Thematic index is something that is good for the current rally, and you need to get out of it when the rally expires. So in a general mixed portfolio, you would have many sectors, many themes, and as stocks get relatively weaker, those stocks move out of any, let's say, any momentum portfolio. So you are not stuck with that sector per se. But when you invest in a mutual fund which is thematic or which is sectoral, then either there be some mechanism where when that theme stops to work, you need to get out of that. Usually people will do what people most people will do is they will buy a thematic portfolio or sectoral portfolio. In fact, even last month's data on new fund inflows is showing that a huge chunk of that inflow is actually going to sectoral funds. So now there are few reasons, and I uh, I don't want to say it, but I'll still say it. A lot of these AMCs, and I'm not naming anybody, uh, give a lot of incentives to their distributors to sell thematic funds. There is more incentive in selling thematic funds uh, for the relationship manager or your mutual fund distributor than a regular large cap fund or a multi cap fund. And this industry is designed in this way that you are the product. You may feel that the product is being sold to you, but actually you are the product, and you have to protect yourself. So from that perspective, don't just blindly buy a sectoral fund just because it has been performing well. So what these folks are very intelligently doing is that they're using the momentum of that sector to sell. I am perfectly happy with with buying of sectoral funds while they are in momentum, but they're not going to come back and tell you that you need to get out of it now if that sector doesn't last in that momentum. It's not going to work like a momentum portfolio. It is sold to you, and most people will never sell it. How many people do you know who will churn a mutual fund, or they will churn it after 5 years when they find that there is no performance, and you've lost your opportunity capital by then. So this is, in some form, in my view, a lot of mis-selling is happening. The mis-selling is also because there are more incentives to sell that. Uh, there is easier sell because I mean, the person can show you, see, sir, in the last 2 years, 70% gain. So you in your mind are calculating in the next 2 years, I'll get another 70%. It may or may not happen like that, right? Usually it doesn't. So the incentives on the other side are very strong to sell you sectoral thematic funds, uh, especially when those sectors have outperformed in a big way. But nobody comes back to you and says, please get out of it, or you buy when, things are not going so well in that particular sector, in case it's a contrarian sort of an advice. So there is a lot of recency bias that you need to be aware of. The seller will come and sell his things, but you need to be aware of that there is a lot of recency bias, and recency bias is good if you are having short-term momentum-based investing, which will also help you get out if you have to. But for long-term buy, hold, and sleep kind of situations, this recency bias is not good. Greed, of course, people want to make money. Anything that is up 50%, 100% in the last 1 year, you tend to extrapolate. It is human mind. Greed is part and parcel of some part of our thinking. A lot of people will not even think about a sectoral fund like a concentrated risk. So somebody comes and sells them that new uh, EV policies are going to come, and sustainable energy companies are going to get invested in this, and hence buy a unconventional or non-conventional energy ETF or something like that. So there is a lot of non-awareness about that industry. Somebody comes and sells you a story, and you buy it, and then the only way to really uh, have any accountability is to wait for 3 to 5 years. Only then you will be able to see that yes, that advice was good, or yes, that advice was really bad. So the risk that is associated with having concentration in any sector is not going to be told to you. You need to be self-aware. You need to educate yourself that I am not going to expose more than X% of my portfolio towards one sector. And if you are doing that, then it is fine. I mean, I'm taking 20% here, I'm taking 30% in this sector, I'm doing this. And whenever those sectors are not performing, I will get out of them. That kind of awareness, that kind of knowledge is seldomly there, especially in the fund industry, because the industry sees this as lazy money, that people who don't have time, people who don't have knowledge, people who don't want to do things themselves are giving us money, and we are going to give them some returns. And essentially, there is no accountability. If we do well, that is fine. If we don't do well, we've got our expense ratio. So from that perspective, this AUM gathering machine keeps getting bigger and bigger and bigger. And once in a while, when chips are down, nobody's making money in the market, a lot of money goes out, and that also usually does not happen unless there is a big scare. And just it just keeps gradually building there, or just keeps lying there till the NAV crosses your buying NAV, and you've lost several years of that money that could have been used more effectively. So this is how the situation works, how things are sold. What's doing well in recent times is going to get sold, and you have to be aware about what you're buying, why you're buying it, how you're going to get out of it, and how much of your portfolio you should expose to this. Thank you so much for watching this video. Let me know your thoughts. I'll be waiting for your comments. Thanks. Bye.